In the last episode, we looked at receivables financing for exporters and why a lender only has value when the collateral is real, controlled, documented, and eligible. That leads to the next layer of risk. Before a receivable can be financed, insured, collected, or explained, the exporter still has to prove the underlying sale. What was ordered? What terms applied? What was delivered? Was it accepted? And is there a dispute that changes the payment conversation? In this episode, we will look at performance risk and contract execution. Why getting paid depends not only on buyer credit, but also on documentation, delivery evidence, acceptance discipline, and dispute control. Buyer credit matters, but it is not the whole story. A buyer may have the financial ability to pay and still refuse payment because the goods were allegedly late, incomplete, damaged, non-conforming, or not accepted. A receivable is not just an invoice total. It is the commercial record of a completed sale under agreed terms. If that record is unclear, the exporter may have a payment problem that looks like credit risk, but is really a performance or contract execution problem. That distinction matters for collection strategy, insurance assumptions, lender eligibility, and internal credit control. The record starts before shipment. Exporters need clarity on what the buyer ordered, which version of the terms controls, when payment is due, what documents are required, and how changes will be handled. A purchase order, quote, invoice, order confirmation, and email thread may not all say the same thing. If price, quantity, delivery terms, inspection rights, or payment timing are inconsistent, the dispute may already be forming before the goods move. This is not a legal drafting lesson. It is an operational point. Finance, sales, logistics, and credit teams need one clean commercial understanding before shipment. Delivery evidence is another practical control. Depending on the transaction, the exporter may need bills of lading, airway bills, packing lists, customs records, certificates, delivery receipts, warehouse documents, or other proof that performance occurred. The specific documents depend on the sale, the shipment, the buyer, and the parties involved. But the principle is consistent. If the exporter cannot show what moved, when it moved, where it went, and how delivery was completed, the receivable is easier to challenge. Documentation is not paperwork after the fact. It is part of the payment file. Acceptance deserves the same discipline. Some buyers inspect on arrival. Some have formal acceptance procedures. Some raise quality, quantity, or timing issues informally and only later withhold payment. Exporters should understand when the buyer can inspect, how rejection is communicated, what happens if the buyer stays silent, and who inside the exporter is responsible for tracking those signals. Again, this is not legal advice about acceptance or remedies. It is a commercial control. If a dispute window is left unmanaged, the invoice may age while the exporter still does not know whether the buyer accepts the sale. This is where insurance and financing assumptions can weaken. Trade credit insurance is generally built around covered buyer non-payment risk, subject to policy terms. It should not be treated as a fix for seller performance problems, product disputes, documentation gaps, or contract ambiguity unless the specific policy says so. Lenders also treat clean receivables differently from receivables that are disputed, poorly documented, stale, concentrated, or difficult to control. The issue is not that insurance or financing has no value. The issue is that both depend on the quality of the underlying receivable. Exporters can make this practical by asking a few questions before shipment. What exactly did the buyer order, and where are the final agreed terms recorded? What documents prove shipment, delivery, performance, and invoicing? When and how does the buyer inspect, accept, or reject? What internal process catches mismatched purchase orders, invoices, shipping documents, and payment terms before goods move? And what happens if the buyer says the goods were late, incomplete, defective, or non-conforming? These questions are not meant to slow the sale. They are meant to protect the receivable. The important point is that payment risk starts before an invoice is overdue. A strong credit file is useful, but it does not replace a clean transaction file. A lender, carrier, collector, counsel, or internal finance team may all need to understand the same basic evidence. What was promised, what was delivered, what was accepted, what was invoiced, and whether any dispute is controlled. Impello helps exporters think through these structures and coordinate the advisory conversation. We do not replace counsel, carriers, banks, or internal credit teams, but we can help make the risk visible before it becomes a collection problem. The takeaway is simple. Getting paid in export trade is not only about whether the buyer is creditworthy, it is also about whether the exporter can prove the sale was clear, performed, delivered, accepted, and documented. Buyer credit. Trade credit insurance, receivables financing, and collections all work better when the underlying transaction record is disciplined. In the next episode, we will look at what happens after the invoice is overdue. how exporters should think about escalation, collections, claim timing, and protecting the relationship while still protecting cash. Subscribe so you do not miss it, and leave any trade finance questions you want us to break down next.